You made a move in the market that doesn't scream of somebody who's that cautious. Okay? You bought Cleveland Cliffs.
I'm not that cautious, especially into the end of the year. I just said I think that there's.
Well, I mean, you bought this for the 3 weeks?
I bought, well, the way this thing trades, it certainly could be a doubtful, because I am a long-term investor. Maybe I'll take some off if it rallies. We'll see. But I like the story. The stock is down 25% year to date. It trades at 5 times earnings, 3 times EBITDA, and I like what they're doing in terms of their balance sheet. I think the demand equation gets improved because of the infrastructure bill. Auto also is recovering nicely, and so I just think the risk reward is really pretty good here.
But this is a soft landing purchase.
Yeah, could be. I'm not saying
you don't buy Cleveland Cliffs if you think we're going into a recession.
I'm not saying we're going into a recession. I'm saying, like, we just don't know, and we know we're going to slow down. But look, I mean, we just got a much better GDP number for 3Q. The Atlanta Fed GDP now is looking for 3% growth, even if we go to 2% or 1.5%. This stock is so cheap at this point, and I like what they're doing internally, and especially because I think they have pricing power.
Unless it's cheap for a reason. I mean, I just go back to the fact that it's hard to buy cyclical stocks like this exposed to the global economy if you.
Right. And you also push back when I bought Caterpillar. And Caterpillar's higher from when I bought it, too. So I do lean more cyclical. I have been overweight energy. I have been overweight industrials, materials all year long, financials as well. And that's been quite frustrating as of late. But I'm trying to be balanced in what I see in the economy. I think it's going to slow, but I also see that these sectors that I'm overweight in are under-owned, underappreciated, quite cheap, generating huge free cash flow. So there's the
now, again, I could easily go to Jim for the Cleveland Cliffs thing, but I'll go to Joe first.
I appreciate that.
Go ahead.
The trigger for your trade to work is the dollar. It's not so much that you need to see the economy make this dramatic battleship turn. You just need some relief for the U.S. dollar. And I think a lot of the material story, whether it's Freeport-McMoRan, Corteva, where I know you are, Nucor, Albemarle, FMC, a lot of that material story is going to begin to work. And you're getting the glimpse that maybe the peak dollar story is in play.
Well, what if China comes back as well?
Well, China is.
Right?
I think that's being priced into the market right now. I think we understand that China is moving towards a full reopening.
Yeah, I would agree, but that's only going to be more tailwinds for these kinds of stocks.
We'll get to the China story, which is obviously significant, and good points that you make. Cleveland Cliffs. Jim owns it, obviously. I know he's a huge supporter of it, so I know what he's going to say. What about you? How do you grade it? How would you grade that?
I like the stock. I like the dollar, the fact that it's down. I'm a little worried now that the dollar is at support. So in the intermediate term, that could be a little bit of a headwind. But you pointed out Atlanta Fed GDP, 4.3% right now for quarter 4. I see a soft landing. I don't see, people are talking about consumer credit.
You see a soft landing too?
Yeah, I see a soft landing. I don't think this thing is going to roll over. I don't think the economy is going to roll over. I think we're going to kind of smooth through the first quarter and second quarter of next year. I like Cleveland Cliffs. I don't own it right now.
I just can't get past the fact that how can we make calls like that when if you make a call like that, then you have to assume that the Fed is not going to get tighter than people think.
Exactly.
You have to assume that the Fed's not going to get over 5% on the terminal rate. You have to assume that the lag effects that are undoubtedly going to occur are not going to be as dramatic as history or conventional wisdom would suggest.
Yeah, you're right. But right now, so they're pricing at 50 basis points in December. I am concerned right now that we see the 25 basis points in February that's priced in becomes 50. So that's where I'm cautious. But you look at the dollar yuan is now back below 7. So that's a tailwind, the Chinese against the Chinese yuan. I do think if the dollar can stay contained here, then we could see a better story around the world coming from the U.S. as well. And then the other part of it is the 10-year is at 3.5. There's a lot of support at 3.5%. If the 10-year starts to move up, it's going to tighten conditions again. So you've got to watch the 10-year. And if we get back to 4, then the story can change a little bit and evolve to slowing things down. But I still see a soft landing.
But energy outperformed, actually, when interest rates got above 4.
Yes.
So it's entirely possible, right? I mean, that commodities can work with a dollar where it is, or maybe even if it firms up a little bit.
Yeah, but those are...
Okay.
Commodities can perform in that environment. Commodities can perform in a slowing economy. It's been proven before, and that's the supply-demand dynamic.
The dollar, which has been brought up a lot here, is primarily based on differences in interest rates and projections thereof. Your comment, Scott, which is dead on, and you heard me say exactly, that I think the Fed funds rate, the peak Fed funds rate, is going to be below that 5% that Powell is talking about and that the market believes. That's, I believe, why the dollar has rallied, at least in strong part.
Well, the interesting part about that conversation is the market for right now believes it, not necessarily because inflation is coming down so fast. It's that the economy may be weakening below the surface enough that the Fed's not going to be able to go above 5%.
It could be, Scott. What you're saying could be the case. You and I think, will agree that, they don't say in the headlines of the Wall Street Journal why the dollar is down. But I think there is a convincing argument that can be made, and I'm trying to make it, that part of the reason the dollar is down on the perception that the Fed won't have to raise as much because of what inflation is doing. And I already went through gasoline futures. There's other commodity futures, freight costs, et cetera. Yeah, wage prices are high, Scott, but I got to tell you, I'm going to go back to last week, your interview with Jeremy Siegel on Friday afternoon. I hope everybody saw it. It's hard at Friday at 4 p.m. A lot of people have checked out, but he said something. Huh?
Why is that hard?
Well, I know you were there, but look, what he said a couple of things. Wage inflation is below the overall headline inflation rate, so how can we blame the workers? And then also he made that good social commentary of, okay, we're going to hit workers with inflation and then take their jobs away. That doesn't strike me as correct.
There's distortion still there. The wages, 2.5% of their wage move month over month came from transportation and warehouse. And the number of employed dropped. They lost jobs in that sector. So there's still these distortions that are taking place right now.
The other move that you made, Steph, you sold Target, and that was to fund the Dollar General buy that you recently did.
Yeah, I still like Target a lot. I still think they're taking market share. They're a leader.
It's an interesting one to sell.
And it's down a lot, so it was painful. But when Dollar General was down 8%,